Stagflation is a rare and troubling economic condition where inflation and unemployment rise simultaneously. While economic growth slows or even contracts, traditionally inflation and unemployment move in opposite directions. When inflation rises, unemployment tends to fall and vice versa. But stagflation defies this logic, creating a complex challenge for policymakers. It's like pressing the gas and the brakes at the same time. In this video, we'll explore why stagflation happens, its impact, and why it's back in the conversation these days. The most well-known period of stagflation occurred in the 1970s, particularly in the United States and in parts of Europe. During that time, oil price shocks triggered inflation, while high unemployment persisted due to the economic stagnation. Central banks were then caught in a bind. Rising interest rates would curb inflections but hurt growth, while lowering them risked worsening inflation. The 1970s taught us that managing stagflation requires a delicate balance and often involves painful trade-offs for governments and central banks alike. In traditional economic theory, the Phillips curve suggests an inverse relationship between inflation and unemployment. When demand rises, inflation goes up, but at the same time, unemployment falls. Stagflation contradicts this principle, signaling that something deeper is at play. Usually, we are talking about a supply-side shock like a spike in oil prices or supply chain disruption. In stagflation, it's not excess demand driving prices, but reduced supply, meaning monetary tools like interest rates may not work as expected. That's why it's so hard to solve. In the wake of COVID-19 pandemic, several economies began showing signs that resemble stagflation. Global supply chain disruptions, labor shortages, and rising commodity prices led to inflation, while economic recovery remained uneven. These conditions revived fear of stagflationary environment. Although we are not fully there yet, the current mix of inflation and economic uncertainty echoes the warning signs of past crises. It is a reminder that today's global economy remains deeply interconnected and vulnerable to complex shocks. Supply shocks are a major trigger for stagflation. Whether it's an oil embargo, war, natural disaster, or pandemic-related bottlenecks, disruptions to supply chains will raise costs for businesses and for consumers. Unlike demand-driven inflation, these cost increases are harder to control. Companies will then pass higher costs on to consumers, driving up the prices, while cutting back on production and hiring, leading to employment. This toxic mix challenges policymakers because stimulating demand won't fix a supply-side problem. Central banks like the Federal Reserve or the European Central Bank are usually tasked with managing inflation through interest rates. But in a stagflation scenario, raising rates to control inflation can deepen a recession and hurt employment. On the other hand, cutting rates to stimulate growth risks making inflation even worse. This puts central banks in a double bind, where every decision carries significant risks. During stagflation, conventional tools lose their effectiveness, forcing a search for alternative strategies and stronger policy coordination. Fighting stagflation requires balancing acts that often involve painful choices. Should a government prioritize fighting inflation, even if it is going to increase unemployment? Or should it stimulate job growth at the risk of higher prices? Unfortunately, there is no perfect answer. Policy must weigh long-term stability against short-term costs. Some fiscal intervention is needed: targeted subsidies, infrastructure investments, or energy policy reform. But all these measures take time and come with political consequences that can complicate the response even further. Stagflation does not respect borders. When major economies experience it, global markets feel the impact. Slower growth in the US or Europe can depress exports from emerging economies. Higher interest rates in developed countries can trigger capital flight and debt stress in others. This interconnectedness means that stagflation is in one region can cascade into a global economic slowdown. For international businesses and investors, understanding stagflation is essential to risk management and long-term strategic planning. Many experts debate whether today's economic conditions qualify as stagflation. Inflation has certainly risen, driven by energy costs, labor shortages, and supply chain woes. Meanwhile, growth remains patchy and vulnerable to shocks. While we haven't yet seen the deep unemployment characteristic of the 1970s-style stagflation, the parallels are concerning. Central banks are being tested, and the global economy is watching. Understanding these dynamics will help us prepare, whether we are policymakers, business leaders, or everyday citizens navigating uncertain times. There is no silver bullet for stagflation. Solutions must be multifaceted, addressing both supply and demand simultaneously. Long-term investments in infrastructure, clean energy, and workforce development can ease supply constraints. On the monetary side, measured and transparent interest rate policy will help to manage expectations. Most importantly, communication and coordination between governments, central banks, and international institutions are nothing less than crucial. The key is to remain adaptable and proactive in the face of a deeply complex, evolving economic challenge.